All right, welcome back. Welcome to 30 Days to the Deal. I'm your host, Ben Humble. We've got a great day happening today. It's day number 19 of our challenge. Oftentimes, we just don't know why we're failing with real estate. And so it's important that we take a second and say, why am I failing? Who knows how to help me? And so I think it's very valuable that as the community, the leader of this group, myself, I'm kind of a jerk. And the jerk part of me says, you have to get results. It's a non-negotiable. And that's what makes me a jerk. But sometimes being a jerk isn't a bad thing, because even though it looks like it's a jerk, at the end of the day, it's because I care about outcome more than you care about keeping your excuses. And so I like to challenge people and push them. And I do this all the time. And so the goal for 30 DTD is that we would do unconventional things like get a deal in 30 days or less. And so that's what we're here to achieve together. We're excited to be here for that journey together. And so on today's 30 DTD, we're going to jump into our training in just a second. It's one thing to get a deal. That's kind of our first rule of business, is we need a deal. The second thing we have to do once we get a deal is that we have to grow another skill, which is financial capacity. We call that OPM. Or for short, other people's money. And you commonly hear about using other people's money to buy real estate. Well, we want to demystify that before we jump into today's lesson. What does OPM mean? By the way, it's a very simple 1-2 punch. Get a deal, use somebody else's money. That's it. And then we can rinse and repeat. Now, where people go wrong or they get stuck on this topic is that they have to be in this order. If you're a consumer and you pay full price and then try to get OPM, you're not going to get it, or it just won't be a good deal for the lender. It has to be 1 and then it has to be 2. Now, let's demystify this for some people. Why would somebody park their money into your deal? Here's the reality. Canadians on average right now have over $130,000 sitting in their registered accounts, RRSPs, etc. From their registered accounts, they could invest in mortgages. It's one of the options through what we call an arm's length mortgage transaction. Canadians also have over $250,000 in home equity, which they could also leverage to invest in real estate. Canada is a very rich country. There's a lot of resources. Unfortunately, I'm going to say this to the best of my ability, Canada has a massive middle class. Canada has a very large job career population. Canadians on average pay a tremendous amount of taxes. And even though Canada has a lot of financial resources, the average Canadian has a lot of resources, the average Canadian unfortunately does not have a high financial IQ. They just don't. They work very hard and they make money. But when it comes time to investing money, when it comes time to create profit in a business, they just don't know how to do that. And so you have these very resource-rich people that are just not resourceful when it comes to investing their capital. And so you have these folks just sitting on cash all the time. So what do? Well, let's talk about some of the nonsense that they engage in. Number 1, they park their money into like certificate of deposits at the bank. And nobody tells them that inflation is 8 to 10%, but they park their money at less than 2%. And so they're basically just eroding their cash every year. That's one thing they do. Second thing they do is they find a complete stranger who got himself a certificate called being a financial planner, and they invest their money with a financial planner who for the most part probably makes less than they do, right? Whose whole job it is to invest people's money into things that they don't own. That's a financial planner. And that sounds like mutual funds. And that sounds like some equities. And so these people who are very smart, but still very poor, invest other people's money on their behalf. And why they're very poor? Because if they were as wealthy as they are intelligent, they would own a bunch of assets, not investing other people's money into a bunch of assets. Very interesting dichotomy. Savings, that's not it. You're not making anything else. Giving your money to a complete financial stranger, that's not it, because sometimes the return is, well, I made 12% this year. Yeah, but then wait till you make negative 3% the next year. The other thing people do is they put their money into other categories, like they put them into their own assets. And that includes things like stocks, etc. And that's sometimes a pretty good thing, but then the stock market also goes down. And so you have all these people sitting on capital, really not really clear what to do with it. And then here comes you. Let's call you Brooke, our friend Brooke. Brooke buys a property, and real estate is what's known as a hard asset. It's a hard asset because it's always in demand and because it has intrinsic value, IV. Intrinsic because of the nature of real estate. It costs money to buy it, to maintain it, right? It's made up of bricks and mortar. It's made up of doors and windows and roofing supplies, and it has real intrinsic value. It's not a paper asset. A paper asset is something that didn't cost anything to create. And so hence it can just go to zero because it has no intrinsic value. Two kinds of value, by the way, IV, intrinsic, and EV, extrinsic value. Extrinsic value is also known as hype, what we feel. So if you're evaluating even a stock like Tesla, let's just say Tesla might have $100 per share of intrinsic value, meaning the cost of the thing, the value, and then it might have $900 of extrinsic value. Height. Real estate has a lot of IV, intrinsic value. In a growth market, real estate can also have extrinsic value, but nowhere near what other assets can have. And so Brooke comes along, and Brooke's a real estate expert, and Brooke says, I have a very certain skill based on a certain set of trainings, and my skill allows me to buy discounted assets. And so I can buy a $500,000 asset. I can buy this asset for $400,000. I have the skill, I have the software, I have the training to use it, I have a system for managing. And so that's what I've invested in, this skill. And so I'm in the business of capturing equity. And so I've been able to successfully capture $100,000 of equity in the last 3 months on a parcel, on a property. Well, another investor says, wow, that's incredible. I need to park my money in something. And Brooke makes a statement. She says, well, I'm willing to pay a very healthy return if somebody wants to help me finance this asset. And so the person says, what's it worth? Brooke says 500, but I'm only looking to raise 400. And so this person would say, well, I'd be interested. What's the risk? Well, the risk is it's worth 500. So the market would have to lose at least 20% before my asset loses value. Unlike stocks, when you buy them, the moment they drop a penny, you lose a penny. With real estate, this would have to drop $100,000 before we actually lose intrinsic or market value because we bought it below market. You can't go to the stock market, by the way, and buy the stock for 50% of its price. It just doesn't work that way. There's a market maker. There's a bid and an ask. It's a very liquid market. Real estate is a very interesting market because although it's a liquid market, it's also very much an unreconcilable market because there's always buyers and sellers and different expectations, and you have consumers working with business owners, etc. So this person says to Brooke, I would invest $400,000, and Brooke says, well, I can give you security, and that security is called a mortgage. And so I will give you a first mortgage on my asset, just like you'd have security in having a stock. Well, not only will I give you security, but here's the good deal. Because my asset is also a business, and I'm going to rent it, I'm going to take my asset, I'm going to fix it, I can increase the value through forced appreciation. I can pay you a pretty healthy margin because my business makes a healthy margin. And so I'm shooting to make at least a 20% margin on my business. I can pay you at least 10% as a return. Now, the other good news is this. I can do it as a fixed rate of return. Just like the CD at the bank, I can give you a fixed rate of return at way above what the other assets would give you. And that there is what a private mortgage is. We use consumer private lenders, private consumer lenders, PCL, to fund our mortgages. So you're like, well, I can't get any money for my property. I don't know where to go. Well, don't go to the banks. We're looking for private consumer lenders who have capital, who are asking the question, where do I invest it? How we do this? We get a property under contract. Because we live in a digital age, we go ahead and we produce what we call a capital raising webinar. And so as we do a webinar, we attract people into our world in a webinar and they join us. We show them the opportunity that we have. And at the very end, we say, if you're interested in knowing more, book a one-on-one call with me and we'll raise capital. This strategy is so effective. Our student, Rianka, on the very first season of 30 Days to the Deal, she got a deal in 22 days and she did a money raising webinar and raised 100% of the financing required to purchase the property. These are two very different skills, but very important. Get a deal, raise the capital. And if you do this, you can join me in the ranks of the Hundreds of Deals Club. I have purchased 300 properties in Canada. Yes. And I've raised $40 million with private consumer lenders. This process works if you work the process. Now, if you're like, wow, that seems like a lot of work. Well, perhaps it is a lot of work. And yes, you'll have to learn. And yes, you'll have to grow. And all of those things are important. But what's the other scenario? You buy 3 properties and you run out of using your own money. And then the banks say you can't have any more doors and that's it. Because that's what's going to happen. And so I meet a lot of investors who come to me and say, well, I already own 3 properties, but the bank said I can't own anymore. Okay. Hey, Ben, I'm maxed out on my TDSR, total debt service ratio. Hey, Ben, I need to increase my income so the bank will give me more mortgages. The bank sells consumer debt products. You are a business owner. And so we have to think about the fact that we are not a good fit for the bank's mortgage products. Just not a good fit. The reason we like consumer private lending is because it is repeatable and scalable. It's 2 elements that are very valuable in real estate because what we teach is a business system. And when you work the system and you get the first deal, that's called proof of concept, you can check a box. When you purchase the next 2 to 5 properties, then you can edify the process that we've used and built along the way and make tweaks. Here's what I will tell you. All of my friends who are in different asset classes, this is what we share. All of us who are focused on being successful and have achieved something, all of us have a really dialed in acquisition process. It may differ person to person, but all of us focus on acquisition. It's a very critical part of our business. All of us focus on leveraging OPM. I don't know one successful investor that just used their own money the whole way through.